Hello and welcome to today's ASX 50 market update for June 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have over 18 years' experience in the financial services industry and a licensed securities and derivatives advisor. The format for today, we look at the macro update driving global equities. We then roll through the ASX top 50 stocks with a particular focus on FY 18 and FY 19 earnings and dividend forecasts. We look at the technical trends, the portfolio allocations, and conclude with a short-term market outlook. Up on screen is a graph of the Dow Jones, and for the most part, our view for 2018 is that US equities sit at the top end of their valuation range. A lot of the good news was priced into equities late 2018, and we think that the market mostly trades sideways and therefore is a good environment for investors to consider using covered calls and being selective on individual stock allocations. When we look at the technical patterns here in the Dow Jones, we can see that from a short-term perspective, it's made slightly higher highs and higher lows, and we've just placed this uptrending support line here as a reference point just to see how long the market trades higher and remains above that. If we were to see that sort of break below that, we'd be looking for a further test to those lower levels of support there, and we'll keep you updated on that via the blog and the Monday webinars. US interest rates have increased by 25 basis points last night. That was mostly as expected by the market, and now consensus is looking for further rate rises in the September and December meetings. So we'll have a look at how that is likely to impact the yield-sensitive names as we look through the ASX 50 stocks today. Before we move on to the individual companies, let's just have a look at the domestic market and see on the XJO. So similar issue here. We have the banks are going to continue to find the environment difficult to grow revenue and therefore grow bottom line profit. There will be focus on cost cuttings. There's potentially risks around where we are in the credit cycle. So it really means the resources and the energy names, healthcare, industrials have to do a lot of the heavy lifting. And just like in global equities, we feel that those sectors are really quite stretched, or as a minimum at the top end of their valuation range. So a good outcome for our domestic market will be it bumps along sideways, and there's still some risks to the downside that need to be thought about. In the case of the XJO reference point here, the last low at 5,964. If we see the market break below that, we'll be looking for a retest back down into the 5,750 range. If, on the other hand, we see the market start to develop support here, that'll be a reflection of maybe the banks bouncing higher from oversold conditions, but we wouldn't expect the banks to continue on with that rally, and we'd be looking for further lower high formations in the bank stocks in coming months. The area of the market that's likely to outperform would be continued strength in commodities, and in particular in the energy sector. But our base case is that for the most part, those names sit up against the top end of their resistance levels. So let's go into the top 50 stocks, and we'll move through those and identify which ones we're buying and which ones we're selling, and look at some of the valuations and yield support. So in the case of AGL, it is a yield-sensitive name. So with interest rates pushing higher in the US, it's probably not a backdrop where AGL outperforms. So we assume this moves sideways. It's on a 5.2% dividend yield. They should grow earnings at about 8%. So we think it bumps sideways, even though it's under a sell condition. If you own it, you want to be selling tight covered calls to complement that return. Aristocrat Leisure, their stocks in the algorithm model following the buy signals, but it does trade at a very stretched PE, 27 times earnings, and only on a 1.5% dividend yield. So again, we think that looks expensive, and even from a momentum play, it's getting difficult to be a supporter of Aristocrat. Amcor, we look back in 6-12 months' time and recognise that this is a good buying opportunity for Amcor at 16 times earnings and a 4.5% dividend yield. Owning it here and selling the $14.50 covered calls, you're generating 10 to 12% cash flow. Comfortable with Amcor from a downside risk management point of view. AMP's very oversold down here, and we think that investors could start to look at accumulating AMP with a view that there'll likely be announcements later this year around the corporate actions, and we're thinking that we could see a split or a demerger of sort of the good assets from the bad assets with AMP, which will provide an opportunity there. So we continue to like that. If we look at ANZ, so it had the lower high formation here at $28. It was removed from the model, and it's continuing to trade lower, and we think that probably plays out a little bit further before you get a rebound in ANZ. APA Group's had a takeover bid from a private Hong Kong family, one of the wealthiest families in Hong Kong, or the wealthiest family in Hong Kong. They made a takeover bid for this at about a 30 or 40% premium, and we've seen the stock price jump. It is subject to foreign review approval, and that would explain why it's trading at a slight discount to the takeover offer. ASX, we continue to like this name, but again, highlight how expensive it is at 27 times earnings and a 3.4% dividend yield. We want to buy this on a pullback, but getting difficult to chase it up at those levels. Horizon, I spoke about this in detail in the last recording. Now, view here is that this stock will reach a point where it is oversold, somewhere between maybe where we're trading at the moment and even down to as low as sort of 375. So the key message here is it was removed from the model under the algorithm sell signals here, but later this year, we may see that turn into a buy, in which case we're happy to take a look at it. BHP, one of the areas of strengths in the market. We can see the bullish structure here of higher highs, higher lows at $34 with iron ore running in a resistance where it is, and likewise with oil or energy prices. It was always going to be tough going for BHP to move too much higher within this current move at the moment. So we look for a consolidation where BHP moves sideways, which fits with our view that we're likely to see the index mainly move sideways. So for people holding BHP, selling covered calls makes sense. From a forward yield standpoint, the stock's on about 4.8, 4.9%. Moving through to the next stock in the list. Just to add there on BHP, it looks like probably they'll achieve a better price for those onshore oil and gas assets in the US, which may see some capital return to shareholders next year, but still the stock looks close to full value for our measure. Brambles, so it's under a lower high formation here, and it's down on support at $9. The stock's still a little bit expensive at 17 times earnings and a 3.3% dividend yield. And for clients that own it, you want to be selling tight covered calls, but just highlighting that it is under sell conditions. CBA, so we actually don't mind CBA. We think it's starting to get into oversold levels down here, and we're looking for a bounce higher. But again, the rally that we get in the banks from these oversold conditions is just going to form another lower high and confirmation of another opportunity to get out of the banks on a lower high formation. So our expectation here is that CBA is getting oversold, may have a rally towards the back half of this year. And if you try to sort of think about the timing, the result of the Royal Commission into the banks needs to be handed down by the 30th of September. We probably reach sort of peak pessimism around the banks sometime between now and the end of September. That probably provides that sort of capitulation point where there's a buying opportunity. The banks rally off the back of that, but it's hard to see the environment even on a 2-year outlook actually supporting bank prices being any higher than where they are today. Computershare, so we had an algorithm buy signal here at around $16, $16.50. The stock's rallied. We're a little concerned that this trades on a high PE. Computershare at the margins, a slight beneficiary of higher US interest rates, stronger US dollars, but at 22 times earnings and a 2.3% dividend yield, we're a little bit cautious there on Computershare. CSL likewise at 39 times earnings and a 1.2% dividend yield, just looking too expensive. Caltex, we've seen some slight upgrades to Caltex in the last week. A number of analysts have upgraded their price targets to anywhere between $32 and $35. Again, we're a little more cautious on this. We think to the extent that clients own it here, you want to be selling tight covered calls. The stock trades sideways at best, and $32 is resistance. Dexus not doing there at the moment, just flagged that it's under sell conditions, which is consistent with a number of these yield sensitive names. So whilst the market, I think, is accepting two more rate rises this year, if the market starts to price in 4 rate rises next year as well, these yield sensitive names come under pressure. Fortescue on a relative basis looks good value compared to BHP and Rio, so having some exposure to Fortescue at this 465 level makes sense to us. Not doing there in Goodman at the moment. GPT, so want to be selling calls over this at 16 times earnings, 5% dividend yield, probably only growing earnings 3 or 4%, either taking profit here or selling covered calls under an algorithm sell signal. Insurance Australia Group, we like this name. It's one of the best performing stocks in the model. It was added back here in early 2017, continues to make higher highs and higher lows. We're now seeing sort of one of the rare opportunities where this stock pulls back, and at around 775, if we were to see it trade there, it's good buying, and I would recommend adding it or accumulating the stock and selling covered call options out into December to turn that sort of 6% or 5% dividend yield into 10 to 12% income through collecting the August dividend and then the extra option premium from the December call option, and still allowing for a bit of capital growth. So looking to buy at 775 and then selling sort of the December 825 or 850 calls provides a good opportunity for portfolios there. Intertech Pivot, we like this name. The upsides are only moderate from where it is at the moment, but at 15 times earnings, 3.5% yield around this 340 level looks okay value. James Hardie, a growth name, but is expensive. 26 times earnings on a 2.5% dividend yield. Higher interest rates in the US at the margins, not good for housing, construction, and the market's just selling off today on that basis. But we do feel that sort of fair value for this stock could be back up to around $24. So being a little bit patient there and keeping sort of a positive outlook there on James Hardie. Lendlease under sell conditions. We think this has just got a little bit expensive at the moment. 14, 15 times earnings, 3.5% dividend yield. I think we watch for this to pull back to lower levels and just see if we get an algorithm buy signal in the later this year. Mirvac Group, we've seen a number of analysts downgrade this stock, concerned about exposure to Australian unit construction in particular, as we start to see some of the settlement delays on new unit purchases, auction clearance rates slow down. So general waning of sort of activity or positivity around the housing sector is weighing on Mirvac from a sentiment standpoint. We have the stock trading at about 14 times earnings on a 5% dividend yield, but at this stage, we assume sort of this 430 level puts in the resistance, 230, I should say, is resistance. Medibank Private, I think this is a buy down here. Again, we see the downside risk is fairly limited, so owning it here and selling covered call options makes sense to us. You're picking it up on a 4.5% dividend yield. If we get a rally back to $3, sell the 310 calls into December, you're getting the equivalent of 10 or 12% cash flow from the dividend and the call option, and allowing for some capital growth. So this is a buy for us down here at these levels. Macquarie Group, a little bit cautious here as well, just on valuation grounds. So we would like to see a more substantial pullback in Macquarie and an algorithm buy signal before we take another look at that. National Australia Bank, so it was removed from the model earlier this year in February when it was trading at $30. We're now more than 10% lower, down at $26. And a little like ANZ, it's hard to see what the catalyst is here for a turnaround in the short term. But my view with the Aussie banks is the same, that we reach peak pessimism sometime between now and when the commission report's handed down at the end of September. Newcrest, our thoughts on gold is that it actually does well over the medium term. Now, it's hard to sort of get a prediction or a forecast on exactly when we see gold rally or break out of this consolidation range. And to put that sort of into perspective, we're really now 2 years into a consolidation for Newcrest. And the stock's now sitting at the lower end of that support range, and we're really looking for a break back through 2250 for confirmation that we're starting to see Newcrest move higher. Origin Energy, we like this name, BHP, Rio, Oil Search. So within this energy sector, within energy and commodity sector within the ASX 50, these are the names that we're drawn to. Any pullback in Origin is a buying opportunity. And it was last triggered under the algorithm here at around 8.30. We're looking for the company to reinstate their dividend in their August earnings result. And on forecasts, it should start to deliver around about 4% dividend yield into F year 19. So we'll wait and see what commentary we get out of the company. And the driver of that is that we've seen Origin reduce their debt from around $9.5 billion down to $6.5 billion, and we think that's sort of more within their target range, and they'll start to feel comfortable about announcing a dividend policy going forward. So with the stock even on a 4% dividend yield, you'd have to say it's fairly close to full value. So the bulk of the, I think, rally is done for the time being. So owning it here, we think the downside's limited, but selling a covered call and trying to turn this name into a stronger cash flow contributor to portfolio is our strategy there. Orica, so it was removed from the model under sell conditions, still looking like it wants to head lower, not doing anything there at present. It was interesting just looking at Orica there. We had the sell signal and it's continued to make a further lower low. Whereas something like Oil Search here, we've had it switch from sell conditions into buy conditions. We got the higher low here at $7. The stock continues to move higher, and we like the look of Oil Search and think that's sort of one of the preferred stocks in portfolios. Qantas, we've had this added back into portfolios into our model, and the stock's pushing up probably close to where resistance is. So this would be another name where we think it's more likely to trade sideways than for this uptrend to really remain as strong as what it has been in 2018. But interesting there that it's certainly under algorithm buy conditions. QBE Insurance, lower lows and lower highs, surprising even with US interest rates going higher. We're not getting much of a reaction here. The stock sold off from 10.50 down to 9.29. Maybe this is something in the back half of this year we keep an eye on as to whether we actually start to get a higher low formation, but there's nothing there at the moment that would draw us towards QBE. Ramsay Healthcare, so this is under sell conditions. We had a sell there at around $71, continuing to make lower lows and lower highs, but there is an increasing argument that the stock's starting to look like good value. At 20 times earnings and a 2.5% dividend yield, it's corrected a long way from its $83 price in sort of 2016, 2017, and it's gone from yielding sort of 1.8% now down to around 2.5%, and somewhere between 2.5%, 3%, Ramsay starts to look okay value from a yield support perspective. Rio, so as with BHP, we've got a very bullish structure here. It's under higher high and higher low conditions. The issue here is similar to BHP, where we feel iron ore prices are close to full value, and therefore we're likely to see Rio bump sideways, supported by share buybacks and a yield at the moment of around about 4.8%. So any opportunity to add to Rio sub $80 is something that we'll look at. South 32, this is removed from the model at the moment. So unlike sort of Origin, BHP, Oil Search, Santos, Rio, they're the names that we're attracted to within the resource space. South 32 is off the list at the moment. Centre Group, full value where it is at the moment. The company is doing a $700 million share buyback, but only around 3 to 4% underlying earnings growth and at 5% dividend yield. Owning it here and selling a tight covered call is okay, because it's likely to mainly move sideways rather than really correct lower in the short term. However, just need to recognise there that it's under sell conditions, and it was one of the profitable trades within the model portfolio. Moving through to Stockland, so as with a number of these property stocks, we're seeing the lower low, lower highs, and at around this $4.35, I should say. I think that acts as resistance, and we're seeing the stock price move lower below that resistance level. I've got Stockland's on about a 6.5% dividend yield where it is at the moment, but I think from a sentiment standpoint, it remains under pressure given some of the slowdown that we're seeing within the housing sector and the data around that. Sonic Healthcare has been one of the great contributors to portfolios over the last number of years, but we just point out that it's under a sell condition at the moment. And like some of these other ones that I've commented on that are under sell conditions, we're not necessarily of the view that this stock materially corrects from where we are at the moment. We think this one mainly trades sideways. So it is an opportunity for clients that do own it to sell tight covered calls over it and strip out the income through the dividend and the call option income. So we have Sonic trading on about a 3.5% dividend yield at present. Santos, so we like this name. So along with Oil Search and Santos, we think that energy prices start to make a support at the current price. As Santos, we can't rule out the possibility that there is another takeover offer. They rejected the $7 takeover price, and we just have to be patient to see whether that takeover offer is lifted to $7.25 or $7.50. But we're comfortable with Santos at or near this current price point. Suncorp, so just pointing out, it's under lower lows, lower highs. This is another one of those names where we think it's probably mostly likely just to trade sideways, and it's supported by a 5.25% dividend yield. So I think that bumps sideways around this level with $14 acting as resistance there in Suncorp. Sydney Airport's a yield-sensitive name, just flagging that we're under sell conditions here at the moment in Sydney Airports, with the stock on a 5% dividend yield. It's likely to remain well supported in the short term, albeit investors need to recognise if US interest rate expectations jack up into 2019, this will be one of the yield-sensitive names that does struggle a little. Likewise there with Transurban, so that same argument applies to Transurban. As the cost of debt rises, these assets become less attractive. They deliver lower returns, but currently at the moment, Transurban's on a 4.65% dividend yield, allowing for about 10% increase to the dividend in FY19. That yield increases to around 5%. So we don't think the sell-off accelerates short term, and there's an opportunity to strip out the dividends and call option income in these names, but you probably don't want to be overweight those until there's greater clarity on US interest rates. If we have a look at Telstra here, we may be coming into a positive catalyst. They got their investor meeting, a presentation on the 20th of this month, and there's speculation that we might see a much more aggressive cost-cutting exercise announced There's even speculation that we may see Telstra announce a breakup of the company into two separate divisions. I think the AT&T merger in the US that was approved by the courts this week, despite Trump's best endeavours to not allow that merger to go through, I think that has to be seen as somewhat of a positive for Telstra. And I think in the years or ahead, we're likely to see telecommunication companies merge with media as a strategy to take on the behemoths in Google, Facebook, and so on, the new media companies that are controlling content. It becomes sort of a paradigm shift when we see the telecommunications companies merge with the media businesses. So I think that's the story for Telstra: 5G and media, but very early in what could be some type of transition phase for Telstra. So investors, I think, still have to be patient, but maybe throughout the course of this year, we see Telstra bottom and move into a higher low pattern. Treasury Wines, bullish pattern here. We can see this sits in the algorithm model. We're just mindful that this rebound up to around $18 fills a price gap, and the stock may find some short-term resistance around $18. To put some numbers on Treasury, it trades at about 32 times earnings and about a 1.92% dividend yield, allowing for the growth. It is a faster growth company, growing earnings at around 20%. So if we factor in that earnings growth into FY19, the stock trades on about a 2.4% dividend yield. Unibail, so this is the new company that has taken over Westfield. So just as a reminder there for what's happened, so Westfield shareholders have been issued shares in Unibail, and a smaller technology company that's been spun off, driven by the corporate strategy of the Lowy family predominantly. Now, Unibail is the new parent company. It retains, I think, something in the order of around $62 billion worth of property assets, mainly shopping centre assets. And the Unibail shares are listed here as a CDI on the ASX. A lot of selling's probably taken place here off the back of investors just wanting to clear out any complexity of the transaction. In an environment where US interest rates move higher, these yield-sensitive names like property trusts shouldn't do well. Maybe fair value for Unibail is somewhere closer to sort of $15, but we just have to wait and see how much selling occurs in the market as a combination of those US rates going higher and investors just choosing to reallocate capital elsewhere. So maybe in next month's recording, we'll provide more detail on Unibail. Not doing there in vicinity at the moment. Westpac, probably a little bit like CBA. If I had to pick two of the banking stocks, that are maybe likely to be the first ones rebounding from oversold conditions, maybe it's Westpac, CBA, but clearly these charts don't look positive at the moment, and the right strategy here was to sell them under the algorithm sell signal at $30. The stock's now 10% lower, so that does not sit in our model portfolio. Wesfarmers been a good performer here. The market's getting excited about the prospect of a leaner, meaner Wesfarmers with the spin-off of Coles, the potential of capital return to shareholders, but the stock is up at sort of a high for the last 5 years, and at around 5% dividend yield, it would appear that it's pretty close to full value where it sits at the moment. And we're not going to get a final outcome on the spin-off of Coles until later this year or early next year for the transaction to proceed. Woolworths expensive up here, but growing earnings at about 8%, which is better than Wesfarmers. But when you put look at the valuation here on Woolworths, 22 times earnings and a 3.5% dividend yield. I think it's full value. You want to be selling calls to complement the return there. Woodside, we're just looking here that it's under algorithm sell conditions, whereas the others like Santos and Oil Search are under buys. So we're drawn to those names over Woodside for exposure to the energy sector. And there we are back to the index. So just to recap where we are at the moment, where we share a view that equities globally and domestically are pretty much at the top end of their valuation range. So it's unlikely that there's drivers over the medium term to push equities on to making new highs. Therefore, the base case is that for the most part, the markets move sideways. Low growth names, you want to be selling covered calls over to enhance the return and keeping an eye on an opportunity to re-enter into sort of resources and energy names on buy signals, on the algorithm buy signals. And there's a couple of sort of longer term structures there that we're keeping an eye on, where the stocks have been in downtrends for a number of years, and when maybe in the back half of this year we start to see those trends reverse and the algorithm high-low formation come through on those names. Thank you for listening in. I look forward to speaking again next month.